18 best candlestick patterns. Let's get started. So the first pattern we're going to cover is the engulfing pattern. This is a type of candlestick pattern that can lead to strong directional movement immediately after it forms. Here we can see that price is moving down, hits this area, and then reverses to the upside. That makes this a potential level of support going forward. And so when we see price moving down towards that level of support, we would be on the lookout for a buy trade opportunity. When it hits that level, we see the bullish engulfing candle form. This is when we have a green candle that completely engulfs the previous red candle. Because this candlestick pattern is occurring at our level of support, that increases the probabilities of this trade, and we see a sharp move to the upside shortly after. Here we see an example of a bearish engulfing pattern. Notice how the red candle completely engulfs the green candle that came before it. This can be a good sign that sellers are gaining strength in the market, and we see a sharp move to the downside shortly afterwards. Next we have the doji. This is a type of candlestick that has the same opening and closing price. So looking at this chart, on the left we see multiple reactions from price coming in at this area. So if we extend this level out further in time, it marks an area of potential resistance. And when price returns to this level of resistance, we see the doji candle form. In this example, the doji candle represented a lack of buying pressure, and so we saw sellers step in and move the market back down. The four main types of doji candles you will see on your chart are the regular doji, the long-legged doji, where the upper and lower wicks are much larger than normal, the dragonfly doji, where we have a long lower wick and price closing at the top of the candlestick, and the gravestone doji, which has a long upper wick and price closing at the bottom. Next we have the momentum candle. This is a candle that is typically at least 2 to 3 times larger than the majority of candles on our chart. In this example, you can see we have a green bullish momentum candle. If you compare the size of this candle to all the candles that came before it, you can see that it easily fits our criteria for a momentum candle. These candles will often result in sustained directional movement after they are formed. This is especially true when the momentum candle is preceded by a period of sideways price movement. The reason why this happens is because whenever price is moving sideways for an extended period of time, we'll have traders entering both buy and sell positions. And so when this bullish momentum candle forms, all the traders who entered a sell position back here will be forced to close their trades, which will add further fuel to the upwards price move. And we'll see similar price movement when we have a bearish momentum candle form, except these candles will often result in a sustained move to the downside. Next we have the hammer. This is a candlestick that will often form at the end of a downtrend and could signal a possible reversal to the upside. The hammer consists of a large lower wick and a small candle body that closes near the high of its range. A candle like this shows us that buyers have absorbed all of the selling that occurred during this period of time, and they were able to move price back up to the top of the candle's range. When we see a pattern like this occurring at a level of support, it can often result in a fast reversal to the upside. The shooting star. This is a candlestick pattern which is similar to the hammer, except it will often result in a reversal to the downside. It consists of a candle with a large upper wick and a small body that closes near the low of its range. Next we have tweezer tops. This pattern occurs when price is moving up and we see a green candle with a long wick on the end, followed immediately by a red candle with a similar size wick. This is a type of reversal pattern, and it can often result in a reversal to the downside after it forms. The opposite of this pattern are the tweezer bottoms. This is when we have a red candle with a long wick on the end, immediately followed by a green candle with a similar size wick. Next we have the morning star. This candlestick pattern often appears at the very end of a downtrend, and it's made up of 3 main parts. First we have a bearish candle, which represents strength to the downside. Next we have a much smaller candle, which shows indecision in the market as the strength from sellers begins to slow down. Finally, we have a bullish candle, which closes above the midpoint of the first bearish candle. This shows that buyers are gaining strength over sellers and will often result in a reversal to the upside. Evening star. This pattern often occurs at the end of an uptrend, and it's characterized by number 1, a bullish candle showing strength from buyers, number 2, a smaller indecision candle, and number 3, a bearish candle showing increasing strength from sellers. This pattern can often result in a reversal to the downside. Next we have multiple candle wicks. This pattern will occur most often at a strong level of support or resistance. Here on the left you can see that price is moving down, hits this level, and then we see a reversal to the upside. Then after price breaks through the level, it returns to test the level from underneath, where it now acts as resistance. But look at what happens when price returns to retest the level a second time. Take note of all the wicks on the candles that are rejecting the level of resistance. This is a good sign that sellers are willing to step in at this level, which increases the probabilities that the level will hold. Every time price moves above the level of resistance, we see sellers step in and push price back down. This is the kind of price movement you want to see to help confirm your entries. On the other hand, if price was approaching a level of resistance and we see a strong green candle immediately break through, that would be our warning to avoid entering that trade. Next we have the bullish Marubozu. This is a type of candle that has no upper or lower wicks. For example, here we can see that price is moving slowly down in this sort of sideways pattern. Next we see this large green candle followed by a bullish Marubozu. Notice how this candle has no upper or lower wicks. This means that the lowest price of this candle was the exact same as its opening price, and the highest price of this candle was the exact same as its closing price. This is a strong sign that buyers are in control of this market, so we can expect further upside. Bearish Marubozu. This is a type of red candle that has no upper or lower wicks. When we see a bearish Marubozu form on our charts, it will often lead to further downside movement, as it shows that sellers are in control of that market. It can be difficult to enter a trade in this kind of situation, as it's hard to know where to put your stop loss after the candle closes. For example, putting it above the most recent swing high will lead to a fairly large stop loss. But in these situations, if sellers are in control of that market, then price will often continue lower without making a pullback. So you can often get away with putting your stop loss above the Marubozu candle. Next we have the spinning top. This candlestick type is similar to the doji in the fact that it represents indecision in the market. It consists of a candle with a small body with upper and lower wicks. Seeing a spinning top form in an uptrend can lead to a potential reversal to the downside, whereas seeing a spinning top form in a downtrend can lead to a potential reversal to the upside. But remember, it's not recommended to trade these patterns by themselves. Seeing a candlestick pattern form at a level of support or resistance, for example, will lead to a much higher quality trade opportunity. If you enjoyed today's video, then please leave a like below, as it really helps the channel out.